What's going on, guys? Alex here, and today I wanted to discuss a common conversation that I have with prospective clients that reach out to me for tax planning advice. And what will happen is clients will reach out, and it'll typically be a couple, let's say husband and wife, and they'll call me and say, hey, we're looking for tax planning opportunities, tax advice, see what we can do to mitigate our tax liability, which are all great questions. So the next step is I start asking, okay, well, what's your situation? Are you an employee? Do you have self-employment income, investment income, jets, islands, investments, S corporations, partnerships? So what do we have to take into account for you in terms of tax mitigation? Because that's where the opportunities will lie if they exist. And in many cases, I get the response of, okay, well, the husband is a W-2 employee, the wife is a W-2 employee, and they may have some 401k assets that they've been making contributions to for the past few years, but that's basically it. And there are no other real significant investments, assets, businesses, partnerships, real estate assets, anything of that nature to work with. And from that perspective, if we just have a W-2 and the 401k that they have from their current employer, that severely limits the options that we have from a tax planning and tax mitigation perspective. Because like it or not, the way the tax code is structured, it's very heavily skewed towards benefiting business owners, benefiting owners of real estate, benefiting individuals who make investments, especially in significant amounts. So with that said, when I get these calls from W-2 employees that just have those retirement plan assets, I have to tell them up front, I have to say, hey, listen, we can discuss tax mitigation strategies, but a lot of our hands are tied behind our back because the rules are structured in the way that they are. And when I tell clients this, because I try to manage expectations, I don't want to book a client for an engagement and then deliver to them really general advice that they can get off of some financial planning website. That's not what clients are paying for. What they're looking for is sort of a whiz-bang, hit it out of the park tax mitigation strategy that just overnight makes their tax liability or a good chunk of it disappear. So I end up telling those prospective clients, we can certainly discuss this, but I want to set expectations up front and let you know that there isn't all that much we can do. We can talk about some generalities. We can discuss some things that you may find on a financial planning website, but honestly, I don't think that's going to deliver you all that much value. And typically these prospective clients, they get sort of dejected. You can hear it in their voice. They're not really excited about that answer, and it ends up not being a fit because I'm not going to take on a client where I can't knock it out of the park for them, especially if the options, and I know up front that they're limited. I don't want to disappoint a client that way in terms of presenting things they could have read on XYZ financial planning website. I wanted to take this opportunity to actually look into the mechanics of why my answer is the way it is, right? Because when we say our hands are tied, the tools are limited, what does that actually mean? What am I talking about? So that's what we're going to delve into here, and we're going to look at how limited the tax planning strategies really are for W-2 employees who don't have other investment assets, real estate assets, or things of that nature to work with. Because then in terms of lowering tax liability, you'll see how few tools we actually have left for the plain vanilla W-2 employee with or without even a retirement account at their current employer. So let's take a look at some of the mechanics here. And we'll start by taking a look at the Form 1040 from tax year 2017. Now, why did I pick this form? This is the last year that is available prior to the enactment of the Tax Cuts and Jobs Act. Okay, so you can see it referred to as TCJA, Tax Cuts and Jobs Act, whatever. It refers to the same thing. But starting in tax year 2018 and moving forward, the Tax Cuts and Jobs Act, for the most part, is applicable. So in 2017, many of the provisions are not applicable, so that's why we're using that as a point of comparison. And I'm comparing that to the 1040 from 2019, which is the latest 1040 that was released. So we can look at some of the changes and see how they're not only unfriendly towards employees, they're almost intentionally so. Now, Let's go to 2017. Okay, so the Tax Cuts and Jobs Act, for the most part, isn't applicable. Things are great in tax land. So taking a look, one of the main aspects that limits our ability to conduct tax planning for W-2 employees has to do with the fact that the standard deduction was increased significantly pursuant to the Tax Cuts and Jobs Act. Now, what do I mean there? Now, if we look at the 2017 Form 1040, you'll see here that for single or married filing statuses, the standard deduction was $63.50 in 2017. What is it in 2019? All right, right here on the front of the 1040, we can see. For single or married filing status, it's $12,200. So if we look at them side by side, it's essentially double. So what does that mean? When you have the standard deduction, that's the deduction that everybody gets for the most part that is using the particular filing status shown on the 1040. If you're going to itemize deductions, meaning if you want a bigger tax benefit than the standard deduction, then you need to use Schedule A and have enough itemized deductions there. I'm going to show you Schedule A. Don't worry about it. But the idea is that you either take the standard deduction, or if you have enough itemized deductions and you exceed the standard deduction, then you can take the itemized deductions instead. But typically, it's the larger of. So while you can have the standard deduction available to you, if you have enough itemized to bring it up over that standard deduction amount, typically it's beneficial to itemize. Now, if you have A&T implications, alternative minimum tax, that may not be as applicable, but let's skip that for now. Let's keep this pretty simple. So we can see that the standard deduction was pretty much doubled, and same goes for the married filing jointly filing status. It went from $12,700 to $24,400, and head of household status $93.50 to $18,350. Okay, significant increases in the standard deduction. And you might say, well, that's great. Everybody gets sort of a free tax benefit there. In a way, yes. But also what that means is if you want to exceed or even get a bigger tax benefit than that standard deduction, the higher standard deduction, now you need that much more in itemized deductions to exceed it. So in one sense, yes, you're getting more deduction available to you, but for clients that are looking to go above and beyond that, now the threshold is higher because the itemized deductions in total now need to exceed a higher standard deduction, right? So the Tax Cuts and Jobs Act really raised the bar, so to speak, on how many itemized deductions you need in order to exceed that standard. So the reason that's important is for W-2 employees, a lot of the leeway that we used to have prior to the Tax Cuts and Jobs Act was there on Schedule A and those itemized deductions. Let's take a closer look at that. So here I have Schedule A, itemized deductions, 2017, before the Tax Cuts and Jobs Act. And let's remember, in 2017, the standard deduction is a lot lower, right? So we're using these standard deduction amounts, which means that in order to itemize or to exceed that standard deduction benefit, we don't need as many itemized deductions in 2017. All right. So with that, if we had medical and dental expenses in 2017, we needed fewer of them to be able to itemize, right? Because in 2017, the goal, if you are using the single filing status, is to exceed $63.50 in itemized deductions, in total itemized deductions, meaning these numbers that are ending up in this rightmost column. Now, there's some math that goes along with it, 7.5%, 10%. Let's leave that for now. But let's just consider the fact that medical and dental expenses, you needed less of them in 2017 to be able to itemize than in 2019. All right. So this is for W-2 employees, might be an extra hurdle in terms of creating an additional tax benefit, because if you had X amount of medical expenses in 2017, that may have pushed you into itemizing territory. Whereas in 2019, being that the standard deduction is a lot higher, those medical expenses need to be that much higher to get you into a place where you're actually exceeding that standard deduction. All right. So going back to 2017, medical and dental expenses, you needed less of them to move the needle from a tax perspective. Now, this area is big because what happened is, and I'm talking about the taxes that you paid. Prior to the Tax Cuts and Jobs Act, essentially, if you paid income taxes of $50,000, if you paid real estate taxes of $80,000, just whatever, extreme amounts, doesn't matter. There were no limitations as far as what kind of deduction you can take here. So as far as the taxes that you paid, if you paid $150,000 in state income taxes, that's the deduction that you'd get, more or less in many cases, right here on line 9. Pretty huge. Now, similarly, with real estate taxes, it was the same deal. So if you paid $20,000 in real estate taxes in 2017, that number would go right here, and it would end up on line 9. So if you paid $150,000 in state income taxes and another $20,000 in the real estate taxes, then you get a $170,000 deduction right here on line 9 of the 2017 Schedule A, and you would be able to itemize. Now, there's other considerations in terms of how itemized deductions work, but that, in very general terms, is how things worked in 2017. So in 2017, what we could do is say, hey, even if you're an employee, if you needed to make estimated income tax payments, meaning that your withholdings weren't adequate to cover your entire tax liability for the year from a state perspective, you may want to make some estimated payments or time them so that you make them before the end of the year to increase this deduction. This is where we had some leeway, a little bit of tax planning opportunities for employees to time their payments of estimated income tax payments to bunch them up in a certain tax year if they wanted to lower their tax liability in that year. So what would happen is this line 5 would be higher, that line 9 would be higher. So in many cases, your itemized deductions would increase. And the reason I say many cases is because if your income is sufficiently high, that may reduce some of the itemized deductions that you're able to take. But just bear with me. Let's keep this real simple. So we had those opportunities in terms of timing income taxes, the payment of income taxes. Then, similarly with real estate taxes, because the way that you get the bills, it says, hey, a balance is due in, let's say, November of 2019, and then there's a balance due in 2020. What you could have done in 2017 is made both of those payments prior to the end of 2017, and that can also potentially increase the itemized deductions that you're taking, and ultimately they decrease your taxable income. All right. So again, there was some leeway, there was some planning opportunities that we had in this taxes you paid area that allowed us to use timing to our advantage to then influence the amount of deductions that a taxpayer may get. Let's fast forward to 2019 and see how that changed. Now, the Tax Cuts and Jobs Act put together, I would say, very controversial limit, and that is this number right here. It's $10,000. Let's zoom in a bit. So what that means is that this entire area of Schedule A is now limited, in many cases, to $10,000. So let's remember how these amounts can change. Now, in 2017, we talked about if you had income taxes, state income taxes of $150,000, you'd have $150,000 right here on line 5 and line 9. How's that different in 2019? In 2019, thanks to the Tax Cuts and Jobs Act, if you had state and local income taxes of $150,000, you'd put $150,000 on line 5A. But on line E, it says enter the smaller of line 5D or $10,000. So the total deduction that you would get on Schedule A is not $150,000 as it would be in 2017. No. Now it's $10,000. So essentially, that W-2 employee lost out on a deduction there of $140,000 of state and local income taxes just because of this $10,000 limitation. All right? So big difference there. So that planning opportunity we had in terms of state income tax payments and when those would be paid is essentially gone in many cases because now we have this $10,000 limitation. Now, if you remember, we also talked about the fact that real estate property taxes would fall into this category as well. They are also subject to this $10,000 limitation. So the timing aspect of planning that we had for state income tax payment, the estimated income tax payments, and the real estate property tax payments, out the window for the most part, because we have this $10,000 limitation to contend with. And this $10,000 doesn't double for a married couple. It stays $10,000. So if you're single, it's $10,000. If you're married, it's $10,000. So there's even a marriage penalty inherent in this $10,000 amount, because if you had two individuals, they can each, that are unmarried, they can each deduct up to $10,000 in terms of their itemized deductions. When they're married, it stays $10,000. So you can imagine the people living on both coasts were not happy when the Tax Cuts and Jobs Act came out, because this limitation so severely increased their tax liability, because it decreased their ability to take these deductions. And if you're living on either coast, you're paying a lot in state income taxes and you're paying a lot in real estate property taxes as well. So that's a few strategies that we had available for W-2 employees that, thanks to TCJA, no longer applicable for the most part. Now, similarly, there was a provision right here on Schedule A whereby you can deduct mortgage interest. All right? And you essentially had mortgage interest on $1 million of principal that you can deduct right here on Schedule A, plus an additional $100,000 for home equity debt, basically $1.1 million. All right? Now, that was an additional deduction that we could put on this form here. And if you paid $30,000 in mortgage interest, you would deduct $30,000, essentially, as long as the principal was within the applicable thresholds. What the Tax Cuts and Jobs Act did in 2018 and moving forward was it limited the amount of principal for which you can deduct the interest to a maximum of $750,000. All right? So basically going from $1 million of principal on which you're deducting the interest to $750,000 on which you're deducting the interest. Again, another limitation on how much of an itemized deduction you can have post-Tax Cuts and Jobs Act as compared to pre-Tax Cuts and Jobs Act, when the amount of principal for which you could deduct the interest was higher. Again, limiting our options. So aside from that, you might think, wow, that's pretty bad, pretty limited. It goes on. Because one other area that was crucial for W-2 employees was this job expenses and certain miscellaneous deductions area. And the idea was that these deductions were known as 2% miscellaneous itemized deductions, which means that if you take 2% of your AGI, let's take a look at where that comes from. So the 2017 Form 1040, the AGI was actually featured in two places. So the last line, let me make it so you guys can see this. The last line on the Form 1040 in 2017 had your adjusted gross income right here. So line 37. All right. So you either take the number from here, or if you want line 38, first line on page 2, have the same number on it. You could take that, and let's just make sure we're in 2017 here. We are. And that would be the floor on those miscellaneous deductions. So this included unreimbursed employee expenses, job travel, union dues, job education, tax preparation fees, other expenses such as investment expenses, safe deposit box expenses. So if you had an investment manager that was managing a taxable brokerage account, here's where you can deduct the fees. If you had safe deposit box that you used to store your investment documents such as share certificates and things like that, you had a deduction possibly there. Tax preparation fees, some tax preparers charge egregious fees. You had a deduction available for that. But this one was probably the biggest hit to W-2 employees, because some employees have pretty high amounts of unreimbursed expenses, or at least they did prior to the Tax Cuts and Jobs Act. And this could be thousands upon thousands of dollars for a lot of employees. So let's say your AGI was $100,000, adjusted gross income, right? And that comes from this line 38 on the 1040. So this is $100,000. And your miscellaneous itemized deductions amounted to $10,000. All right. You'd use that 2% as the floor. So 2% of the $100,000 in AGI is $2,000. That's your floor. Anything above that, you would be able to deduct right here on line 27. And if you had $10,000 in total, 2% miscellaneous itemized deductions, and you had that $2,000 floor, then this would be an $8,000 deduction right here on line 27. Let's fast forward to post-Tax Cuts and Jobs Act Schedule A. What the Tax Cuts and Jobs Act did to this 2% miscellaneous itemized deduction is pretty much eliminated it, all right, for the vast majority of taxpayers. So what you have going on, and we can compare the two forms possibly here. So as you could see, in 2017, there were all these items listed. And then in 2019, you could see this area is a lot more sparse, right? It just says other itemized deductions. It doesn't talk about unreimbursed employee expenses, tax prep fees, investment fees, and so forth. So this was another area in which we had a little bit of leeway in terms of tax planning for W-2 employees. We could say, okay, well, if you have some unreimbursed job expenses that you had some flexibility in terms of the timing, maybe you want to pay some of that prior to the end of the year as opposed to on January 3rd or what have you. Similar with tax preparation fees. Hey, maybe you want to prepay for your tax preparation prior to the end of the year. That may make a difference. And any of these other investment-related expenses. So if you have, let's say, a $3,000 investment fee due, you can have your advisor take that prior to the end of the year and increase the amount of itemized deductions that you have for that year. With the Tax Cuts and Jobs Act, all of that is basically out the window for federal purposes. Now, for state purposes, it could be different, but that is yet another tool that we lack in terms of moving the needle from a tax perspective. And this is why I have to tell these clients, these prospective clients, that we can discuss tax mitigation, we can discuss tax planning. I have no issue in doing so. But before I charge you my hourly rate to do so, I want to be on the same page in terms of the fact that you may not get as much value out of this as you're anticipating, because there's no magic wand. There's no whiz-bang strategy to all of a sudden erase your tax liability if you have just W-2 income and maybe a 401k at your employer. And the reason is, it's not because I have something against W-2 employees, far from it, but if there are no other assets for us to work with, meaning no other investment accounts, no other real estate properties, things of that nature, that severely limits our toolbox from a tax mitigation perspective. All right. And some other tax benefits I wanted to touch on that are available to essentially business owners and owners of real estate that aren't available to W-2 employees. Let's talk about the QBI deduction, qualified business income deduction. It's a deduction that was put forth by the Tax Cuts and Jobs Act of basically up to 20% of a deduction of the lesser of taxable income or qualified business income. Huge benefit. For some people, this is thousands of dollars in terms of a deduction. But if you're an employee, you don't qualify. All right, so QBI, huge benefit, not available for employees. Another one, accelerated depreciation. There are provisions in the tax code like Section 179, bonus depreciation, de minimis safe harbor. A lot of these provisions are great and can definitely move the needle from a tax perspective. But if you're a W-2 employee without a rental property, without a business, without any sort of investments, we're severely limited in terms of a lot of these tools. And the accelerated depreciation would be applicable to, let's say, a business or rental property for the most part. And if you're a W-2 employee, those aren't available as well. You would need to acquire a real estate rental property or something of that nature before we can even discuss that. So we talked about the $10,000 limitation on Schedule A. meaning the Tax Cuts and Jobs Act limitation for the deduction of state and local taxes, right here, that's not applicable, believe it or not, if you paid those expenses for a rental property or if you pay them as part of your business. All right, that deduction solely exists on the personal side of things, believe it or not. Now, I could tell some employees out there, they're getting heated. They're going, wow, I feel like I'm getting screwed by this tax code because all of the benefits are flying by me. I'm not getting any of this. And in some cases, you'd be correct, all right? It's just how the tax code is structured. I'm just the messenger here. And I'm not saying that this is good or bad, but it just is what it is. The tax code is geared to reward investment, reward business, employment, is really on the short end of the stick when it comes to income taxes, unfortunately. Similarly, if you have significant amounts of capital gains from the sale of investments, if you want to defer or even not have to pay taxes on some of those gains, there's something called the Qualified Opportunity Fund or Qualified Opportunity Zone investment that you can make that will allow you to not only defer some income tax liability, but also not pay any income taxes on some of the gains resulting from those investments. Now, it's very complex how that's put together, but the point is, if you don't have significant investable assets and gains related to those assets, then that's really off the table, unfortunately, because it just would not be applicable for your average W-2 employee. Similarly, as a self-employed individual, if you have your own business, S-Corp, partnership, you have a lot more leeway with regard to your retirement plan contributions because first, you have a lot more flexibility in terms of the deduction, right? You're no longer limited to just your portion as the employee. Now you can actually deduct the employer portion of the contribution as well. So you have more flexibility from a retirement plan perspective when you're self-employed, you have your own business and so forth, than if you are an employee and you have a 401k at your company, and then you could just make salary deferral contributions. So a lot more flexibility there. Again, not something we can discuss if an individual just has a 401k at their employer. The only question then becomes, how much should you set aside? Should you even participate in it at all? There's opportunity costs inherent there. So there's definitely something in terms of planning that can be done, but it's not going to be all that significant and mind-blowing. Again, clients are looking for this kind of nuclear tax tool when they call me. They don't want to know that, hey, instead of contributing 4% of your salary to your 401k, you should contribute 6%. That's not going to impress anybody. Now, in terms of the 2% limitation as well, we talked about on the Schedule A, a lot of the deductions are limited for this 2%. Now, that 2% itemized deduction limitation does not apply to business applications for the most part. So, as an example, tax preparation fees that you'd pay at the personal level, they in 2017 were subject to this 2% limitation. In 2019, pursuant to the Tax Cuts and Jobs Act, at the federal level, you get no deduction for those tax preparation fees. But guess what? If you had a business and you had a tax preparer prepare your business returns, now you can deduct tax preparation fees for that business. That could be a $1,500 S-Corp return, could be a $1,500 partnership return, what have you. The point is that whereas on the personal level as a W-2 employee, you cannot deduct any of those amounts, if it's just your tax returns, your 1040 that's being prepared at the federal level, not a deduction. If you have a business or if you have a rental property, any allocable amounts for tax preparation, accounting fees, legal fees, things of that nature, all of a sudden are deductible. So again, the way the tax code is structured, like it or not, it's definitely tilted to benefit those that have real estate assets, that have investment assets, that are self-employed, that have a business. And like it or not, if you want to maximize your tax advantages, then you need to play by those rules. That may change over time. There may be some different administration that comes through that tilts the scales in the other direction. But I could tell you just a lot of these provisions, they end as soon as you mention the two words W-2 or the one word, whatever you want to call it. So I hope that provides a little bit of color as to why tax planning opportunities are limited for W-2 employees. It's not that us tax professionals have anything against W-2 employees. We love them, all right? And I know there's some people with a W-2 making $800,000 a year, $1 million a year. I know it. Trust me. But it still comes down to the fact that if that's the only form of income and there are no other assets to play with, no other businesses, rental properties, things of that nature, you have to be comfortable with the fact that the tax mitigation opportunities for you will be limited. All right. So hopefully this was helpful. If you have any questions, definitely hit me up in the comments. I love reading your comments. Feel free to like this video, share it, and till next time, see you later.